What's up, Friday? Chuck Fulkerson, TradersArmy.com. Hope you're having a great day. We're going to do our morning market commentary, taking a look at what's happening. Not a whole lot has happened this week. Actually, didn't do a session on Wednesday because just really didn't feel like there was enough market movement out there worth taking a look at. And this is really kind of the end of the summer doldrums, right? We're in the throes of August, if you will, which is really sometimes the toughest time of the year to trade. So we're going to take a look at some opportunities today, see what shows up. But I stress this regularly. Don't force trades when they're not there. I think oftentimes what happens is people think, well, I'm a trader, I got to trade. Well, I'm a trader, I'm got to trade. That's not the case. You got to look for opportunities when they present themselves for what's good and for what's going to be the right thing for you. So keep that in mind. If you're new to the channel, click the subscribe button, hit the notification bell. Throw me a thumbs up if you watch us on a regular basis. Come on, do it real quick. I know you'd like to. Hey, I appreciate that. That helps a lot. Okay, let's go ahead and get started with the big picture. So taking a look at the big picture this morning, we're going to start with our S&P, which is up 1.75%. We had scaled to a brand new all-time high. Actually just hit that all-time high a few minutes ago. A few hours ago, actually, is better to say. We've pulled back a little bit off of that level, but we did talk about a potential breakout above this 44.33 earlier in the week. So those of you that have been with us for the week, if you're just allowing that thing to run, you're doing okay, allowing profits to continue to go higher. And, there's really no reason to look for shorts from where we are. I mean, we are scaling to new heights, if you will. If I look at this on a 15-minute chart, I will be, understand that there's this Globex low right here that is a spot that a lot of people are going to say, hey, we could break down from there. Well, we can, but one of the things that I always look for, what are called bull and bear traps. And to me, that could be a little bit of a bear trap. And the reason that could be a bear trap is because you've got a decent little level of demand right here where price could give you a reversal. So we're looking at this as a potential bear trap for a setup. Now, why is it called a bear trap? Well, because the bears are going to get in it if price breaks below 44.50, and you may have a little pile of demand here that stops it from going any further down. This is a pretty small level. It's not an ideal level and not the absolute greatest. There are certainly things about this that I don't love. Your stop would have to go at the tightest below 44.44 in this instance. You do have also this old area of resistance, which may act as new support as well. So you might want to give yourself actually a little bit more wiggle room on this level right through here. So keep that in mind for a potential bear trap area sitting here right off the all-time high. The next would be the NASDAQ. So now the NASDAQ is not following the S&P, right? The NASDAQ's actually coming off a little bit, and I think that could be a little bit of a reaction to the fact that that the tech stocks of the Nasdaq aren't having the same growth as some of the bigger S&P stocks, which are continuing to move a lot higher. And the Nasdaq stocks could be a little bit of a reaction to interest rates, where there's a little bit of a fear of a potential rise in interest rates soon. And that actually is going to impact some of these tech stocks first, some of these more high growth stocks before it's going to impact some of those blue chips that are paying the yield. And so that would be the main concern there, and that would be why they're not moving quite as fast. Looking at the Russell 2000, which we've taken a look at for a while, it's also hovering very, very sideways, not really going anywhere. Matter of fact, look at this on a daily chart. You can see that we are really in a tight range here in the rut. On our Sunday night session, we talked about a potential iron condor in the Russell. So those of you that did the iron condor in the Russell, so far it's working out your way, and still kind of moving right along. But the NASDAQ is now starting to do a little bit more like the Russell, right? What that tells me is that if the NASDAQ and the Russell start doing the same thing, the S&P is soon to follow. And so that's my only cause for a little bit of concern on the S&P's rallies, that the NASDAQ was unable to get a new high. So with the Nasdaq being unable to get a new high, that Russell or the S&P rally is a little bit suspect in that case because we haven't created a new all-time high this week in the Nasdaq like we did in the S&P. Doesn't mean, by the way, that I'm going to be out here shorting the darn thing because there's really no great levels to short. Um, but we are in the context of a fairly slowing trend to the upside. It's almost more of a sideways trend on the 4-hour chart. Here would be our same line for that bull trap area or that bear trap area, and here's that area of demand. Now this one's not as clean as the area of demand on the S&P. Really, this area down here might be one worth exploring on this smaller time frame, this little 15-minute level just below the pivot low. All right, so let's slide over and take a look at crude oil. So looking at crude oil, we do have a couple of areas in here that look like quality supply levels above us. My problem with this one is that we came really close to it and we based in front of the level and didn't do anything. So if we come close to it, base in front of the level, don't do anything, I need to remove that line, remove that area. So my next area to take a look at from a supply standpoint doesn't come into play until right up around here. So we're sitting right there on a daily chart at what looks to be a potential reversal point. Now, the only thing that I find interesting is that we were unable to create a new low, and this 65 level held. And by being unable to create a new low, we're now in a zone between creating a new low and creating a new high. It's not done either one. Typically, we see these things continue to fall, but this could also create a little bit of a descending triangle pattern and bounce up again off that 65. So I'm still a bit more bearish than I am bullish on the bigger picture scale when it comes to oil overall. But I don't have a great reversal in order to re-engage my trend direction. Now, we do have this speed candle move from earlier in the week, which is a decent area of demand. And so I'm okay if you want to take a little intraday trade off of that 15-minute demand zone. But be aware that if you do that, you've got a little bit lower probability just due to our big picture trend. So I'm going to make it a confirmation style entry. Remember, confirmation style entries come into play when we are, anytime we're going counter trend, our general position. Aside from that, I don't really have a whole lot. Now, if we base in front of that level, look for a short on a breakdown. And then last but certainly not least is gold. And gold, we had a really nice opportunity here on our retest back into this region for a potential short. But notice, basing in front of the level. Basing before the level is what we consider the kiss of death. This is the KOD, meaning the level is no longer valid. The better level is the one over here up at 1800 anyway for a potential short, but that's fairly far away. Well, the fact that we're basing immediately below the level tells me that this actually could now create a bit of a breakout opportunity because you've got essentially clean air to go from 1765 up to 1800. So keep that in mind for a potential breakout above that region. If I just look at, say, a 15-minute time period, you've got higher lows on this smaller time frame. A pullback into this low would be a decent pullback. You've got this little noisy cricket level where there's this wick over wick area, noisy cricket on a 15-minute chart where we could see a bit of a reversal. So looking for those areas are usually going to be pretty good levels for quick 2-to-1 moves out of that zone. So those are our four major markets, taking a look at the big picture overall. One of the things about these markets is we see a lot of disparate price action, right? Going up, going sideways, going down, going small time frame up. There's a lot of disparate price action, and this is because of the time of the year, right? So keep that in mind as we look at the big picture. But now let's take just a real quick, brief minute taking a look at our stock of the day. So for our stock of the day today, I want to talk a little bit about Tesla. And I think that Tesla has been really humming along in a sideways price action for quite a while. We've just been very, very sideways for quite a while. And the thing that I'm looking at when I look at Tesla is that we are sitting below this area here, which was a gap fill short. Now, this tells me that we have come to this area of supply and we're chewing up all of the sell orders that exist in that area. So, when you chew up all the sell orders that exist in that area, the next move would essentially be a breakout to the upside. Well, one of the studies that I take a look at is the CCI, with a CCI setting of positive 100. And a CCI 100 breakout setting, we are sitting right at a good spot for a CCI 100 breakout setting, where price will oftentimes move very well out of a breakout above that 100 mark. And that's kind of what we're looking at this point, is that we are consolidating, getting a little bit of that basing put together with an opportunity for a breakout above our CCI 100. You can see the last time that we truly gave a good break above the CCI 100, that we had some basing, you got a really strong move out of it the next time through. Now, this time our basing is a bit longer, so we will see what happens there. But you can take a look at potentially getting long somewhere above this region, somewhere above this 730 area may be a good opportunity to get long. Now, if you go to a smaller time frame and look at it on a smaller time frame, you can actually see, you can really trim that down into a little bit more precision and call it right about there, 725.63. Now, we're opening up in the pre-market actually down. In the pre-market, we're trading at 720 by 721. So we're actually going to open up a bit down this morning, which takes me down to somewhere in just a little bit below here, right there. So opening up is just a little lower than where we closed yesterday. But yesterday we closed on the high, and ending the week on a high is a strong potential. Now, you taking a look at it, I'd have to say, well, what trade can I set up? So this is our stock of the day. Trade the stock of the day any way you want. I'm a big believer in trading options around positions like this. And so if I pull up my Traders Army implied volatility range indicator, which you can download that indicator at tradersarmy.com, we have our implied volatility over the last 1 year. And you can see that our implied volatility over the last 1 year is the lowest that it has been. We are just continuing to see volatility sell off on this position. So, with lowering volatility and expecting a movement, I'm okay if you say, you know what, I just want to get in and get a call. Well, it's still a 43 vol, so it's on a $700 stock, so it's still fairly expensive for most traders and investors, although some of you may be okay with that. Let's go take a look at this from a bull call spread standpoint. And from a bull call spread standpoint, if I'm going to be looking to trade this, let's go out until October. And looking at the October on the bull call spread, what I'm really looking for is a net delta of 0.25. So in order to get a net delta of 0.25, I've got to buy an option and sell an option with deltas that have a difference of 0.25. So if you see here, this 720 call option has a delta of 0.54. The 770 has a delta of 0.40. That's a 0.14 net delta. The difference between them is 0.14. So I would really need to come down and look at something like the 730 by 830. So that's $100 spread. If I'm going to be doing this 730 by 830, and that's how you're going to get the net delta of 25. Now, in this case, I've got a $31 debit on that position. So it's still a little more expensive than I think what most people are going to be comfortable doing in these trades. Now, our rules say that if I'm going to do a credit spread, I need to have less than 50% of the spread as my debit. In this case, I've got a $100 spread with a $31 debit, so it's less than 50%. And I've got a delta of 26, which is 26 cents for every dollar of stock movement. Looking at it from a bigger perspective, if I take this, your breakout on this position this is what your risk graph looks like. The purple representing your profit and loss today, the green representing your profit and loss on expiration. So my trade itself has a break-even cost of entry price plus debit. So you can see that my break-even is all the way up here at about 761. Current price sitting here at 722. That's the break-even price, and I certainly don't plan on holding it quite that long. But to make it $30 to 760 is really not going to be much of a chore, right? Once we break above 725, I believe that you've got a clear path up to 800, even 850, fairly easily, and that nets for a pretty decent return on the overall position. Now, what if it falls apart and goes against me? Well, if it falls apart and goes against me, I've got to understand where's my stop loss going to be in this particular trade. So one of the things that we want to look for is where's my last pivot low. In this instance, I think you're looking at a stop loss. Really the tightest you can have it is down here at about 697. That would be the absolute, really the tightest level that you can place it would be at about 697, which if I move my stop over to that area, that's about a $600 stop. And then if it comes up and hits its target at a little over 800, you've got about a $2,600 return at 822. And if it starts to move your direction, you can certainly take your stop and move it to break even. So the trade might still be a little bit rich for some people's blood, and that's okay. If that's a little bit too rich for your blood, you're not a big fan of it, I'm giving you the foundational basis that we look at for our vertical spreads using a $100 debit here. You may say, well, Chuck, I'm okay not getting a 26 delta. I just don't want to drop $31 on the position. Great. So go in and do the 730 by 750. All right. And really now your debit is only $8.65. Now, I'm not making anywhere near as much. My delta is only 583. And so when I do it that way, my risk is now down to about $150 if it goes against me. My reward is at about $540 if it goes my direction. So my reward to risk ratio is still fairly similar on that position. And so it allows me to still get access to the trade while I won't make as much on the position if it goes my way. And it's only tying up $865 in my account to do one contract, because the absolute most I can lose is the amount that I put into this debit position. So a little bit more detailed on that trade today, but that's a really great way to think about trading options for this bullish environment. That's all I got. So I hope you guys have a phenomenal day. It's a Friday. Enjoy your weekend. Once again, don't force trades. If it's not there, don't take it. Look for the right setup and the thing that makes your trade make the most sense. And I will be back. See you soon. Hey, thanks for joining us. If you like what we do, please make sure you hit that subscribe button. It's the only way the computers know that you're actually alive and really care. And go to tradersarmy.com today to learn a bit more. And if you want to see some of our other videos, click here in the box.